All right. Hello, hello. This is Abel Pacheco, your host for the Five Talents podcast. We are super excited today, as always, get to talk to an amazing individual, Mr. Rama. Rama, man, I'm very thankful that you got to join and, thankful you got to join us. So, first of all, how's it going?
Yeah, going well, Bill. Thank you very much for this opportunity. Grateful for that. Thank you.
Yeah, I appreciate it. For those of you that don't know, Mr. Rama Krishna is the founder of USHA Investment Group, and really Rama's come from a background in multifamily and real estate and investing in the syndication world because he's an equity partner in about 750 units of multifamily, so a lot of doors in multiple different markets to Florida, Maryland, North Carolina, and he's a general partner in a number of units as well. So about 64 doors. So he's got 15 years background, which I'm excited to talk about too in the IT world. So for those of you that are in that space, he's been on the software side for a number of years, and I'm excited there because if you heard me, I worked at Rackspace for about 10 years, another 3 years at a hosting company. So I was on the hardware side, and Ram was on the software side. So anyways, I'm excited, just to hear a little bit more about his story. And really, he's got a good amount of experience analyzing deals, underwriting, even some of the capital side and the asset management side. So we're gonna have a great conversation. And Rama, thank you very much for joining. So in your own words, brother, please tell me who you are, what you do, and let's start a great conversation there.
Sure. Yeah, thank you for the introduction. So basically, I came from India. So originally from India and came to US in 2007, around 2007 time. So as IT professional, so I worked in IT side around 15 years, and around 2014, 15 time frame. So because of my friends, I'm introduced to real estate. So that's how I get into real estate. So initially, I invested in the single families, townhomes in North Carolina. I invested in few deals. Later, so working full time in IT side and also managing these properties to be challenging. So that's how I'm introduced to multifamily space. So I did explore learning multifamily through bigger pockets or podcasts, listening podcasts, or reading books, and also through various mastermind groups. That's how I started, and initially I invested in a couple of deals to get the track record, from multifamily space. So invested a couple of deals as LP, then switched towards the GP side, and so far we closed 64 units deals in North Carolina market. So that's how I started. I also run podcast called Multifamily AP 360, and also organize conference Multifamily AP 360.
All right, multifamily AP 360, Mr. Rama the man. So I'm excited, brother. I've seen your face around a number of the social medias, a podcast, the virtual events, and it's exciting to hear somebody like yourself, coming in from another country, from the U.S. It gives me a lot of inspiration, a lot of motivation. Like, man, I was from Texas, from the US here, and our family, has a background, foreigners moving in and just kind of really seeing the inspiration that is the quote unquote American dream to be able to come in 2007 from India, work a number of years in IT, and then man, now you're an owner, now you're a part owner in a lot of doors and a lot of real estate. Man, that's inspiring, brother. It's
Yeah.
inspiring.
Yeah. Thank you. Thank you. Yeah.
Yeah. Well, so let me back up for a minute before, because I definitely want to talk about real estate. But what intrigues me a lot is just mindsets, paradigm shifts, how people actually move forward. Mindset's such a big reason why some people have success in real estate or ventures or new entrepreneurship, ventures, and why others just never get started. Right? It's the action that inspires others to make a move. So tell me a little bit about your background. Were your family members, your family, your dad, mom? How did you grow up? Was it I was always going to be an entrepreneur, or was it your parents that way? Tell me a little bit about your background, just so we can get a good understanding, man.
Sure. So came from a small family, like mainly like agricultural family. So my father was farmer, so mainly into uh, agriculture side. So my mother is a housewife, kind of stuff. So born and brought up on small city in south in India, and also studied there like up to engineering. So basically, we don't have track record of business side. So I'm the first person,
You're the
from
first one.
yeah, from education point of view, so study we did higher studies like engineering. So that's how my background. Yeah.
Oh man. And even just taking a leap. So from a farmer to an engineer, that's a big one. From India to the US, like what was it that spurred the action to say, you know what, I'm gonna move to the US? How did that even happen, man?
Yeah. So during my college studies, during engineering side, like a lot of my college mates and classmates, they also came to US. So that's how I got that, uh, inspiration, and that's how I came to US. Yeah.
Yeah, that's great. That's great, man. Seeing other people and just kind of, hey, let's they can do it, we can do it type of thing.
Correct. Yeah.
All right. And an engineer for a number of years. So what did you do in software? Were you a designer, a coder? And when you say engineer, for those that don't know the IT space, like what the heck did you do? What did you have to learn and what'd you do?
Yeah, IT side. So I did engineering and mechanical engineering. So then I switched towards IT side. So mainly IT side, I was into quality side, quality lead and quality manager, quality aspects of the software, software projects and products.
Makes perfect sense, man. So what in the world caused a jump or a leap from IT into real estate? How did that even happen? How did that occur?
So mainly like, always want to do business, even, during the IT side also. So I always try to explore multiple options, but I didn't get luck or success into other aspects. I want to do MBA or those kind of stuff. But, somehow I introduced to real estate through my common friend, I mean, college classmate. So that's how I got interested, and I started investing into real estate. So I got some success there initially into single family side. So invest in multiple deals and some success. Then, because of busyness and, multiple deals, managing multiple deals across multiple locations bit challenging. So then, I thought of, exploring different options. So that's how I came across multifamily space. So I explored that, and, I learned a lot about multifamily. So, and also, so there are so many commercial asset classes, but um, and I attracted towards multifamily because of, always demand will be there. So everyone needs a roof, and, so multifamily is the best asset class for that, So that's how I identified multifamily.
All right, man. So your very first deal, was it your own money? Did you partner with someone? Did you find yeah, how did you find the deal? What was the very first transaction that you did?
Is that from single family or multifamily?
Yeah.
A single family I did myself. Is all single families is I invested my own money. So mainly like I found through some news ad in local market. That's how I identified that home is in maybe some bad location. Price also very low, and also I invested in some good location with town home style. Yeah.
Okay, very, very good. An old ad, man. What year was that?
So around 2014, 15.
Okay, very good. Well,
Yeah.
so you did a number of transactions, it sounds like, diversification, rough neighborhood, probably fixer upper, and then
Yeah.
maybe a nicer, it sounds like a nicer deal,
Yeah.
nicer side of town, nicer townhome. So how many houses, single family houses, did you kind of invest in before you made a jump to becoming a limited partner passive investor in multifamily?
So around 7, 8, say 7 8 single families and townhomes, I can say.
Okay. Yeah, that's awesome. We were similar, about 7, 8 houses, and then we're like, man, it became a little bit of work. What was the aha moment? What was the big pivot or the jump to say, you know what, I've got to go to multifamily?
So mainly like a lot of phone calls or a lot of issues with property management, or or reselling the property. So that really frustrated me a little bit more. no, this enough, now I need to switch towards, some other aspects where I can manage a bit easily, that's how I introduced to multifamily.
There you go. There you go. Well, okay, man. So let's fast forward. So now you're in commercial real estate. You've done a number of deals and transactions. You've invested passively. Now you're putting on, commercial real estate events, virtual summits. You're a podcast host. Walk us through a little bit of that. How does that happen? How did you jump from here to there?
Yeah, so from a multifamily side, I always want to work on GP side only. My goal was always, active investor. So, but like, to build that track record, so I started with, passive side. I did like few, I underwrite a lot of deals and submitted and did a lot of property tours, but I didn't get success. So there, during that time, I invested passively and also, and also keep looking for active side also, and also join various mastermind groups and learn and partner with other active investors in this space. So like around 2011, 2021, we were awarded with one deal, GP side, and it took around 4 to 6 months to close the deal. So mainly I'm into acquisition side, strong into acquisition side, underwrite the deal and analyze the deal and, did the proper due diligence and property tours, those kind of stuff, and also raise a little bit capital. Right now, I'm participating in asset management of this deal.
All right. Well, hey, man, congratulations. Congratulations on the run, Rama.
Thank you.
That sounds awesome, brother. Uh, all the success that you've had personally, professionally, now, in the commercial side, in the commercial arena, and really putting on the efforts to get bigger exposure. I'm excited for the future, man. I'm excited for everything that
Yeah.
you do.
Thank you very much. Thank you very much. Yeah, I'm also excited. So a lot of potential is there in commercial multifamily space. So that's how I jumped into this space, and
Yeah.
also started podcasting. So networking
Cool.
it will help me networking with a lot of experienced operators like you in this space. So and
Yeah.
also and conference also definitely helping me to reach out more number of experienced operators and building
Very
that
good.
networking opportunities.
Very good, brother. Very good. Well, let's dive into some learning for those that are, really listening to the show. We want to, first thank a couple of our sponsors. We've got some really great folks over at Anderson Advisors that have helped us for a lot of years. When we were single family investors, we leaned on them for legal, for tax and risk advice. And now, even then, just want to thank them very much for being some of the greatest sponsors that we've had that have actually done real estate. But for the educational side, for those that are trying to figure out, hey, look, I want to be a passive investor. Maybe you're an entrepreneur, maybe you're a business owner, and you're trying to figure out how to invest in real estate without having extra work, having extra time, effort, and energy. You want a little bit of the underwriting nuggets. You want some analysis insight on how to better evaluate, underwrite, and do the analysis on your deal so you know what to be invested in. If you are an active participant in deals, you want to understand, what are the current trends in underwriting and analysis. So, let's pivot or move a little bit, Rama, to help others, understand that. So let's talk about underwriting. At a high level, underwriting, we're looking at the financial analysis of these apartment buildings or commercial properties. They're more than just single family houses. You have income minus expenses. And at the end of that, you have a debt service payment. Below the line, above the line are all the expenses, everything that it takes to run the apartment building, your payroll, your staff, your marketing, your contract services, all of these lines that go into your expenses. And you're trying to figure out, well, what's my potential rent if I fully rented it out? And I'm going to have a little bit of vacancy. And I got to factor this stuff in when I make an offer on a property. And that's what underwriting is. It's our financial analysis on whether or not we pay the asking price, below asking price, or were we paying a market premium, or do we want it at a discount? And then we're trying to factor in, man, what's our goal, our execution plan for the future? to have a big exit, right? So that's what our underwriting, our financial analysis is. So when we talked to Rama earlier, he goes, "Yeah, I like the underwriting, I like the analysis." So let's talk a little bit about that. So what, Rama, in your own words, like what is underwriting? What's financial analysis? Maybe let's start here.
Sure, sure. Mainly like to identify to find the value of the property, we need to do underwriting. So that's how we find the value of the particular property, right? So we have like underwriting models, different underwriting models. So we do get T12 and rent rolls from the brokers. So based on that, we'll find out how much average rents for different units, single one bedroom or two bedroom, something like that. And also from T12, we'll get all kinds of incomes, total incomes, other incomes, all the stuff, and also different kinds of expenses. So based on that, so we'll underwrite. So we'll plug in all the rents, like what is current average rents and what are the projected rents, after, with renovations, without renovations, based on our business plan. And also we'll plug in all the income, like so gross income and other income, last two leases, and other bonuses or any kind of losses, all stuff we'll include on income side. And expense side, like you mentioned, all the expenses like marketing, contract services, advertising, admin side, and payroll, T2 payroll, and repairs and maintenance, turnovers, all those stuff we plug in. And also we include like what is the purchase price from the we'll get from brokers, cap rate and purchase price. So we'll plug in those numbers and some other factors like exit cap rate. So based on income, so we'll get so going in cap rate from the brokers based on that market. So we'll plug in exit cap rate. So we'll expand like each year 10 bps points. Like if you're going with 5 years, so our exit cap will be always 50 bps points than current going in cap rate. That's how we underwrite. And also like we'll go with different rent escalators, how much we're projecting each year, how much rent escalating each year, and how much expenses we are adding for each year. That also we plug in. And also mainly we'll get insurance quote from the broker, and real estate tax also we'll check with the tax assessor of that particular county, when exactly it will be reassessed, how much it will be. So the stuff we plug in. After putting all this stuff, we'll get final value or final results, like how much cash and cash it will generate, and how much IRR it will generate, how much AR generate. And also we'll do different kinds of permutations, combinations, like 3 years exit, 5 years exit, agency debts, bridge debt with a different interest rates, like LTVs, also different LTVs. If you go with bridge loans, we'll go with 70 LTV, and also most of the times we'll get CapEx budget also with bridge loans. If you go with agency debt, so normally LTV will be a bit lower. So current markets, we are underwriting around 60 LTV, 55 to 60 LTV. And also sometimes we'll get interest only periods like 3 years, 2 years, those kind of stuff. Normally we'll get these quotes from the lender. Based on their inputs, we'll plug in those numbers here. So we'll do all these combinations, and then we'll get final results.
All right, look at that. Look, there's a number of things that we're gonna go and try to unpack a little bit of this, but man, Rama was one of those individuals that, when I heard mechanical engineer, right, to start, and then a developer, software on the software side, when you put those things together, a formulaic kind of mindset, 1 + 1 is 2, times 3 is A, B, C, X, Y, Z. Here are all the inputs. I go left to right, and when you look at financial underwriting of a business, like multifamily, you start to realize, oh, okay, I see some similarities, I see some patterns, I can see the profit and loss. And while it's a bit complex, the more that you do it, the easier it becomes time and time again. So as a passive investor, you're trusting an operator, a syndicator, your investment team, that they're doing the underwriting. But it's, it's good to know. It's like this is the basic principles on whether or not we're going to invest in this deal based on this underwriting, based on this analysis, based on this financial outcome. So thanks, Rama. So you mentioned a couple things. We're going to kind of go back and talk about a couple of the points that Rama mentioned, right? So average rents, your assumptions that we're making, the premiums that we think we can get, our loss to lease, all of those things kind of incorporate all of the renters that are there today, what they're paying. They're paying $1,000. If you have a loss to lease, that is, that you can rent it today for $1,100, but you're stuck in a lease with a previous renter at $1,000. So you've got a loss to lease, and you're trying to burn that number off, especially with other renters. Maybe the market premiums that other competitors are getting, maybe down the street they're getting $1,200 a door. So you're trying to figure out how to turn those rents as quickly as possible. And now, Rama, that you've been in the business a little bit longer and you're looking at this, what are some of the areas that you get these data points? Like how do you even validate, in your area, what my current rent is, what the average rent is, what the premiums, what people are getting, and then how I could, potentially do better? How do you get those data points? And something simple for the passive investors and, to boil it down to.
Sure, there are multiple ways you will get, average market rents in that current market, So you can get it from the local property management. That is one way. So if you using apartments.com, you can get, so if you search with that particular property, you will get, around that property, so you will get market demand for, other assets near to that property. That is other way. And also you can use, some paid subscriptions like CoStar or Yardi. So using those subscriptions, so you will get, average market rents in this market. Another tool is like Rentometer or something. You can use that one to get market rents. So mainly like for that particular submarket. So thing is like, you can reach out those other competitive properties and ask them, what is their rents for 1 bedrooms and 2 bedrooms or similar size of property, similar kind of units that your target property. So that's how I will get the proper average market rents.
Yeah, very good. We use some of the tools that we're using for rents today when I'm trying to figure out, hey, what do I think I can rent out these units today for? What will they be able to be rented for next year and the year after? Are some of the same data sources, right? So CoStar, trying to figure out what's my annual rent growth and what's this particular submarket in this zip code going to be able to be rented for in the future. And then apartments.com is a good and easy way to, you check some data, you can look at it online and you see what they have available and what unit mix and how much the rents are going for. But I was coaching our underwriter on our side too. I was like, and don't forget to pick up the phone and call some of the property managers that are on site, because you never know, somebody's got some kind of special or somebody's got kind of some deal, and now your competitors are charging the same $1,000, but they're doing the first month's rent for free. Now that's your competitor. Or potentially their 1 bedrooms are super high price, or they're 2s, but if they're 99% occupied, they only have 1 door available, 1 unit, then, it doesn't really, on that point, it's like, that's not really going to be a great competitor because there's only 1 unit. I'm trying to fill up the next 10 or 15 or 20. So, there's different things to weigh out, and they're all great ways to look at, beat up, scrutinize, stress test your own assumptions and your own underwriting. So, all the things to look at, right? Okay, so you mentioned a couple other things, Rama. I'd love to hear, a little bit more about. Like you mentioned cash on cash, a return, entry cap, exit cap. So for those investors that are looking at, even one thing that Rama mentioned, entry cap versus an exit cap, and he puts in 10 bips a year, roughly speaking. I'm sure every deal is a little different, but 10 bips a year, 10 basis points of a spread between the time he bought it, every year that he plans to own it has a certain spread, so that he doesn't go in assuming that just because he bought it today, it's going to be a higher value tomorrow. He's saying, I bought it here today, 10 million bucks, but I'm going to assume that it may be worth less at a higher cap rate. So he's kind of doing that assumption and stress test on his own. But why don't you elaborate a little bit more on, how those assumptions affect underwriting a little bit, Rama?
Yeah, definitely. So main reason behind going with this kind of underwriting is we want to go with conservative underwriting. So we want to assume things may go worse. So mainly to cover up any kind of unforeseen situations or unforeseen market conditions. So that is the main reason behind going with conservative underwriting. So even current market situation, so we need to spread a little bit higher because of interest rates are going up. So that definitely another factor, it will impact exit cap rate. So that is the reason we are even spreading more than 10 bps for exit cap rate. Yeah, and also we are doing different kind of stress tests. Mainly we are is that exit cap rate also different from each and city. So every market it is different. So if it is Greensboro, its exit cap rate is, or going in cap rate is different, and also Raleigh, Charlotte, or Greenville markets. So those are the things we need to consider.
Yep. Yeah, there's a conservative. We're trying to put our assumptions and maybe not, I'm not sure if you mentioned the actual word, but as you were talking, I'm thinking stress test, right? We're trying to basically push our financial modeling to some limits and saying, what happens if 3 years ago our stress tests had number of renters? What happens if our occupancy goes from 97, 96, 95 to 80 to 75? And we're saying, whoa, what happens if we lose renters? 3 years ago stress testing versus stress testing today, it's how high are my interest rates going to go up, right? I still care about occupancy, but man, 4 years ago, my underwriting is a different stress test. And now it's, well, what happened if the lender only gives us 60% LTV at a 8% interest rate? And the Federal Reserve, the Fed is still moving up interest rates as we speak. We record this show January the 30th, 2023. So the Fed's about to meet again, and sure as the sky is blue, we're assuming another hike, right? So those are the stress tests, right? The more you have that, and more you can prepare for it, you can at least say, we looked at it, and we know we can, foresee the rough unforeseen, right? Those circumstances there. So
yeah, definitely. I want to add a couple of other points.
Please, Rama.
Yeah, definitely. Rent growth projections also, sometimes we'll project with 3% growth. How it will work if you project rent growth is only 2%, and also occupancy that you also touched. If your occupancy is 95%, how it is performed, how are the return? If its occupancy is only 90%, how are the returns? Same way, like exit cap rates. If exit cap is 6%, what are the returns? If its exit cap is 5.5, how are the returns? 5.75, how are the returns? Something like that. We on the road. I just want to add these points also.
Yeah, agreed. Another point is like, what the heck is happening to interest rates? I have investors, every single day asking me, well, what do you think is going to happen? And I'm like, I have no idea. If I had a crystal ball, I promise you that I'd be leveraging it to the full and tell everyone know exactly what I think is going to happen. And, we'd be raising $100 million because we're going to turn it into two. And, the frank and honest, opinion of mine is, like, I lean towards other sources of information that are more knowledgeable, looking at more historical records, looking at more data points. Easy one that I look at, for you, if you're following interest rates, Chatham and Pensford, and they have forward-looking curves, and they're trying to sell insurance as a rate cap to this interest rate, but they are heavily attuned to data, and they have interest rates going up all the way till June, July of 2023. So for the next 6 or 7 months. And then a pivot is not necessarily going to be a sharp drop in rates, but rather the pivot will be no more change, maybe flat. Interest rates are going to stay high, but remain flat for another year before they start to make a pivot, maybe going down. So, for the next year, year and a half, we're trying to figure out what kind of deals can we get at higher interest rates. Know they're going to stay high. Know they're going to be in this upper area of interest rates for the time being, and just got to maneuver around it. So that's what we're seeing, and I'd love to hear your take on it as well.
I totally agree with all your points. I'm also maybe getting same kind of resources. So I'm also agree with a lot of points you mentioned. Like next 2 quarters, it may go up, interest rates may go up. Maybe after like third quarter onwards, it may go down, like not sharp as you mentioned. It may go down maybe 25 bps down like that. It may go on each quarter 25 bps. That's how I'm getting news. And so yeah.
That's what Rama's crystal ball says.
Yeah.
So wish we knew for sure. And this was part of the risk though, right? Like
Yeah.
where some investors, I guess part of the risk is you have to take the risk. If you don't take the risk, the outcome is certain. Inflation is eating up our money. If you're sitting on $1 million cash and it's in a bank account, inflationary, period of time that we're in, minimum 8 to 9% is what people are forecasting that our spending power is reducing every single year. So it's just getting eaten up. So whether you think you're not risking it, you already made a decision. And that decision is I'm okay with 8 to 9% loss every single year, right? So we've got to muster up some courage, some foresight, some, knowledge to say, look, I've got to take a risk because if I don't take a risk, I'm going to lose already. So the aversion is the aversion to loss. Most people would rather take a loss than risk for most people would rather avoid a loss, even if the chance or the risk is a little bit better to win. And so we've got to muscle through that loss aversion to try to say, okay, how do I make this money work for us, right?
Yeah.
So on that, what are the mindsets do you come across? Maybe some of your investors or you that you've had to work through some of the mindsets to push forward and say, I'm going to keep going. I'm going to keep investing.
Yeah. So from my point of view, I will keep looking for, deals. So I will underwrite more conservatively, taking all the points we mentioned so far, like it will go higher interest rates, and not much rent growth maybe this year and next year. That's how I underwrite and keep looking for right deals. If that meets only my criteria, then I will proceed with next steps like submitting LOIs and proceed with acquisition side. So underwriting conservatively and still actively looking for deals, building that relationship with the brokers and reaching out more brokers in these markets. From investors' point of view, I do see there is a decrease in interest in last maybe 3 months, something like that. So main thing is up to them. So if they're interested, if they find good opportunities, they can still take that risk.
Yeah. You got to stay sharp. You got to keep looking at deals. You got to keep underwriting. You got to keep talking to brokers. You got to keep seeing what's out there in the market. If you're not in the market and you're not looking and you're not grinding it, then you really don't know when things change. You're not going to know. You're not going to be able to sense it. And if you wait it out, quote unquote, wait it out, I don't mean the difference between moving forward or not, but I mean waiting it out. Like I'm not going to underwrite anything. I'm not going to talk to anybody. I'm not going to even look at deals. Well, then you really don't get a sense of when the tide starts to turn, right? So you have to be out there. You have to be looking at deals. I agree, and you got to stay warm. You got to stay warmed up, right?
Yeah. You have to be active. Yep.
Yes, sir. Well, Rama, it's been amazing talking, and I really appreciate it. I think a few listeners got a little bit of education today on some analysis and underwriting, so I appreciate it. When's your next summit? Maybe you can tell us some dates and get us some links, and where should our listener base go to, and maybe any affiliate links or whatever you have. Just happy to share that with our listener base.
Yeah, absolutely great conversations around underwriting analysis. Thank you for that. And so mainly like I'm organizing this multifamily AP 360 virtual conference. It's coming up on February 17, 18, 19. So mainly we are focusing on mindset, passive investing, active investing, and also behind multifamily, few other asset classes also. So they can register going through multifamilyap360.com. And if they use AP15, they will get some 15% additional discount.
All right, there you go. There you go. And Rama, who should be attending the event, and you know what kind of mindset should they be in to say, you know, I should be attending. I need to go to that.
Yeah, anyone related with real estate, so who want to invest actively or passively, they can attend this virtual conference. New investors or experienced investors, so they can always learn new stuff from these experienced operators, and also you have opportunity to network with other hundreds of in active and passive investors. So that's how they can benefit.
My man. All right, Rama. Hey, man, it's been a pleasure talking to you. I really appreciate it. The last note before we go, right, or the last question, is there anything we didn't get to talk about today that you really wanted to bring up? Something I didn't ask about and you were just excited to share, just, you know, wanted to give you, you know, the last few minutes if there's anything else, any words of wisdom or last nuggets here.
So definitely, identify your strong strengths, your unique ability, and focus on that. And also identify like complementary skills set persons and leverage their skill set and to build, your team and grow in multifamily space.
All right, get it on. Well, Rama, I really appreciate your time. Sincerely appreciate it, brother. And wish you nothing but success and God bless you and everything that you're doing. And thank you very much for joining. Appreciate it.
Thank you much. Likewise, and good luck with you also, Abel. Thank you.
All right. Thank you. To our sponsors over at Anderson, we just want to say thank you very much. If you are looking for some links, go to the show notes. They will direct you towards some free packages they always have. So we want to say thank you very much. A big supporter of theirs. I've used them for years, so I highly trust them. And for our Five Talents podcast listeners and subscribers, thank you very much for all you do. If you heard something that was valuable today, go to our podcast, subscribe, and leave us a written review that make more impact than you know. And look forward to sharing. And I'll see you at the next show. See ya.